how to passively make money, how to passively invest with real estate. And I just love Tony Robbins so much that I thought that this video was so on time. It's 2023, and I want him to set the stage, and then I'm going to go into my presentation.
Independent without spending less than you earn, and what do you got to do with what you don't spend? You got to invest the difference. Because what I want to show you right now is how do you build what everybody should own. Every one of you should leave here with your own personal money machine. You want to create a money machine. A machine that while you're sleeping is making you money, right? So you're no longer trading the most valuable resource you have in life, your time, for money. You want to trade money for money. You want money to go to work. You want to put that money to work for you so while you're sleeping it's making a difference. You want to create a machine, and that machine you want to create is something you want to be able to feed you at some stage where you don't have to work. That's what the money machine is. The second secret to this is you got to reinvest. How many of you have ever made a big hit in your investments and went, oh my God, that's so cool, and took the money and spent it on something? Raise your hand, say aye. Come on, say aye. I know you all, anybody's invested has done this. If you got a big hit, you go, oh, this is it. Nothing wrong with that, but you got to make sure a significant amount of that you reinvest your returns so you get compounded what? Compounded growth is the most basic principle in the world. We all know it intellectually. But are you emotionally associated enough that you're really utilizing it to its maximum capability? If you don't, you're not going to get financially free. You will never get financially independent by your earnings alone. Every one of you in this room is going to lose money. Every one of you. There's no way. The person I work with, one of the top financial traders in the history of the world, top 10 in the history of the world, is not even right half the time. How could you make billions of dollars if you're not even right half the time? Not even 51% of the time. I'm going to show you in a few moments. It's known as asset allocation. It's the way you invest. It's what you do. That's what's going to shift this. So first step, spend less than you earn, invest the difference. Second step, reinvest it so you get compounded growth until you reach the home run, your money machine, until you reach a critical mass of capital, of investment capital. When you get to that critical mass, and what determines the critical mass is how much you need for the lifestyle that you want. Once you get to that critical mass, what it provides for you is what you're investing for. Who knows, no matter what investment you're doing, what are you really investing for? Whether you're investing in cars, stocks, bonds, real estate, financial instruments, what are you investing for? You're not investing for returns. That illusion will keep you from getting to the end game. If you're wealthy, here's what makes you wealthy. Income, not assets. Assets you can buy, and assets change in value all the time. You need income. This is the only reason to invest. You invest for one reason, so you have an income for life without working. And to do that, you got to build a critical mass of capital, that the interest on it alone will give you that income, and you can have the life you want without working. And the only way to do that is do those first two steps. Spend less than you earn, invest it, reinvest it till you hit that critical mass. Now, how to do that is actually a lot simpler than you think. We make things more complex than it really is. You got to think of this as your target. In order to achieve what you want, where you have a money machine, here's what you must do. You must pick out a minimum financial goal for yourself. Even to achieve your minimum financial goal, you got to pick out a specific amount of money that you're going to invest every month, every year, no matter what. A specific percentage of your income. If you don't do that, forget the rest of this course. It's a waste of your time. Because you'll go make a bunch of money, but you won't be practicing the fundamentals, and eventually you'll make a mistake and you'll lose it. Let me tell you another secret to life. If you do the right thing at the wrong time, you get pain. If you plant in the winter, I don't care how hard you work. I don't care if you work day and night and you work to the bone and you plant your seeds in the middle of the winter. What's going to happen when fall comes? Are you going to be rewarded, yes or no? No. So if you don't understand that the seasons are changing, you're in trouble. What is asset allocation? It means out of the money you have to invest, we're going to create 3 buckets. Really simple way of thinking of this from now on. The first bucket is the security bucket. When you think about investing, think of 2 types of investments. There are fixed income investments, and most of you are clear what this means. What does it mean when it's a fixed income investment? Who knows? What does that mean? You got a guaranteed rate of return, assuming they deliver. And anyone cannot deliver, including the US government. They haven't not delivered, but they could. Is there risk in any investment, yes or no? So just ratios of risk. And as we know, no risk, no no reward. So if you don't invest, you're going to lose if you invest at times. But if you don't invest, you've already lost and you can never win, never have a money machine, never be financially free. The second type of investment that you can make, and it helps you understand what you're going to do, is something that's going to be growth driven. And growth investments are investments where you probably have a much greater potential for growth, which means you get a greater return if you're successful. But if you're not successful, do you have a guaranteed rate of return? Yes or no? No. So in a growth investment, you have the potential of greater return, but also greater loss. The security bucket is where you want to put investments that are secure by their nature. Because they're secure, is this going to give you a huge compounded return per year? Yes or no? But can it give you a huge compounded return even if the number is small if you do it long enough? Yes or no? So what we want to do is your first investments have to be in your security bucket, and everybody wants to do the opposite. Okay. The question then becomes, what percentage you put in your security bucket, what goes in there? Well, here's some things that go in there. If you don't have at least 2 to 6 months worth of cash that covers your overhead, you're in deep trouble. The first step to getting financially secure, not financially independent, is to make sure you got enough cash that if something happens, you can go for 6 months. You got the freedom. What else might you put in there? Types of investments. An IRA goes in here, right? Pretty secure. Insurance. The insurance is protecting you. That's part of security. What else could go in there? Your home. Don't think of your home as an investment, because for most of you, you're eventually not going to sell that home and eat it. You're not going to sell your home and get income off it. Now, some of you maybe, you made a stage of life where you're accumulating the same homes, and eventually you're going to sell and buy a smaller home and take that critical mass that came from selling the big home, and it's going to take care of you for life. If you're doing that, great. But the place to think about your home in terms of leverage, put it in your security bucket. How many agree with me on this, by the way? Say aye. Because, by the way, if you don't have a home, you're going to be really stressed out, right? So I got to think of my growth outside my home, really. Think of your compound interest outside your home. Your home may be a bonus for you. And fixed income investments all fit in this category. Now, what's the second bucket? Second bucket is growth. 2 ways you're going to learn about growth. The buy and hold strategy, which is the strategy of an owner. And by the way, that buying and holding, that is less risky to some extent than momentum because of the timing, but it can be just as risky. What is momentum trading? That's when you're no longer an owner, you're a trader. A financial trader, everybody's a financial trader. Most of you trading time for your money. Here you're trading money for money.
I just pulled that video up, and now that video is going to be at the beginning of every presentation because it's so perfect that he explained how you're supposed to deal with your money, how you're supposed to deal with income. And this is something that I've just recently grown to learn. It took years. So let's get into the presentation. And the only reason why it would take me years is because I didn't have a generation before me telling me what Tony just told us. And so, when you don't have a generation before you kind of giving you some hints, they're just only learning themselves, then that's when you basically, have to learn as you go. So let's get into the presentation. So my name is Tanae Williams. I am the fund manager of a real estate fund that buys multifamily apartment buildings called the Clearview Eastern Fund. A little bit about me. I've been a real estate investor for 2 decades. Simultaneously, my earned income also was in insurance. It was also in mortgage lending. I was a mortgage banker for a period of time, and it all started when my little munchkins were just munchkins. And I had a thirst to learn about how to make their lives better because I had them very early on. I was a teen mom, had my first son, Mandela, at 16, and my second at actually 1 month shy, at 20 days shy of being 19. And I just figured that out literally yesterday. So I always said I had him at 19. But that is those two, because of those two, and just my thirst for knowledge, I guess, because growing up in New York City, you just have this thirst for wanting to be successful. And, seeing downtown and seeing Wall Street, I always loved the Wall Street movies. It was always my goal to be in finance, to learn how money works. And so over time, as you can see, insurance, I was a stockbroker also for a very short period of time. I had my 663, 7, did all those licenses, licensed mortgage broker, did all of that, and simultaneously went to workshops to learn how to buy real estate. I would fix and flip, I would do wholesaling, I did all of that beginning, did my first ground up construction at 27 years old, which actually was a failure. But we tried. And at this point now, having 47 apartments that we have in 9 separate 2 to 4 family buildings, and 102 hotel rooms that we lease option to other nonprofit organizations for homeless overflow. We've accomplished a lot, and these are my boys today. This is, we run this business as a family. My son, this is the younger one. He's actually in New Jersey and New York, running around between the properties. And this one is actually in New Jersey right now, back from DR. But he is about to go back to DR. We do a lot in the Airbnb space, corporate rentals, and just a lot. We learned the hard way that being a landlord wasn't the exact space that we thought it was going to be, because as you're growing in the real estate business, you just learn, okay, I got to get to this next level. But, we've all heard about this crash that happened in 2008. We just had the pandemic. There's a lot of things that end up hitting you sideways that you didn't expect when you made your plans. So success is never a straight line. It's always a complete squiggly, you get knocked down, pandemic happened. Okay, let me get back up. 2008, you get knocked down. Oh, the mortgage company you were working for gets, shut down. We just saw, if you're in the tech space, we just saw thousands of people get laid off in the tech business. And it's like, oh my goodness. And I understood why all of those people got laid off. We think it's because of some impending recession, but I just had a light bulb earlier today, because I don't know if you know that new app, it's called Chat GPT, and it's an open AI. I just saw this thing literally create a program. I went on YouTube and I was looking at how to use it, and I found out you can tell it to write code. I'm like, what? So I had it write a code. It wrote a code. So if you got AI writing code, hello, maybe they don't need as many programmers, because they figured out how to get the program to write the program. Holy moly. So things are always coming at us. So this is real estate. We have to rethink it. We have to rethink real estate in general. I know if you thought, okay, I'm going to buy my house, and I want that white picket fence. I want that beautiful house. That was one of my first things that I did. I thought that was the goal. That was the home run. 4-bedroom, 3-bath, custom home, gorgeous. I was going to put the pool in. It was a new build. It didn't play out the way I expected, because one of the things that I learned about buying your own personal home is, depending on what stage in life you're at. But for us, buying my personal home was the wrong timing. So you will not see me online in some huge luxury house, because I just don't think it's a good idea right now. It is a liability for a large, huge luxury legacy home. And so I learned that later. So you've got your, but a lot of people, if you just have your average home that you and your children and your family are growing up in, and then you're going to grow out of that home and downsize, or you're going to upsize from your apartment to your home, that is typical. That's average. You have no thought about it's just a regular home. You're looking for appreciation, and that's the only way it's going to pay you. Then you have your earned income investor that says, you know what, if you're out there on the Instagram, I know you know something about, you may have heard about arbitrage, Airbnb arbitrage. People are going and finding landlords that have empty rentals and then putting Airbnb. That business recently, unfortunately, remember that squiggly line thing? That business just got hit smack dab in the face because there's a lot of regulations coming down really hard on people that have Airbnb. And so people are having to create their own sites and do something else with their clientele. So, you know, Airbnb arbitrage, wholesaling, even if you decided to be a developer and you build, home, entire phases, phase 1, phase 2, you've got, you're building 10, 20, 30 houses. I know a lot of people that do build to rent. These types of incomes in real estate, I put in the earned income category because it's not passive. Passive income means it's coming in whether you do something or not. That's passive. That's truly passive. Whether you work or you don't work, it's going to come in. That's passive. Appreciation investor is your simple buy and hold landlord. There's a lot of us out there who thought, okay, I'm just, let's say you had your first home, you moved out of that, you bought another home. I teach that in house hacking when in my real estate course. I show you how to buy your first 2 to 4 family property, move out of that property, buy another one. And that's how we got to 47 apartments. And I'm looking for the appreciation and I'm looking for the rental income because I specifically did it with 2 to 4 family properties. However, before the last few years, many people did it the traditional way where they just bought single family homes. That they're just looking for appreciation. They have one renter in one single family home. Then you have your passive equity investor. What usually happens in each one of these stages, as you start to learn how, okay, you heard Anthony Robbins talk about, you need security, you need passive income. It needs to be in the security bucket and it needs to be collateralized. It needs to be something secure. So we know that real estate is a business where over time, real estate is going to appreciate. You don't have to think about it. The question is whether or not you have the right timing, which is something that he talked about also. If you have the right timing when you purchase, your property is going to appreciate over 10, 20, 30 years regardless, but are you buying when the rate is 7% or maybe in the 80s when the rate was 27%? So, there's all of these different factors of why you could fail at real estate. However, we are focused on a particular space that just doesn't fail. There's no promises, no guarantees, and I'm going to go over my disclosures in a minute. But what apartment complex do you know? This is where everyone lives, right? We all live in an apartment until we move into a house. So if no one's buying because there's a 7-8% interest rate, what are you going to do? You're going to stay in your apartment. So this is a great, just outlook at what are you going to do with your money. Tony Robbins talked about it. Let's say you've got your 4 to 6 months saved up. So if there's an emergency, that emergency money is saved up. But you also have something called a 401k that maybe your corporation has been matching. And so you have a nice little nest egg in your 401k. Maybe you're a tech guy who got laid off, or a nurse, or a doctor, or an attorney. Not attorney, but someone who got laid off and they left their 401k sitting at their last job. You could be an attorney that basically you're making excellent money and you're putting the right amount of money and percentage of your income into your self-directed IRA. Here's what happens. Those monies are usually sitting in something. So that vehicle is there, and that 401k vehicle is usually sitting and invested in something. So you have money in your savings account, you're not going to get much interest, if any interest at all. So you can't put money into a savings account and expect it to grow or pay you any exponential income. A money market account gets a little bit better, but what is it, 2%? If you can only put, let's say, $6,000 to $10,000 into your 401k or your IRA every year, and you've been doing that for 10 years, the whole premise is that if you're going to retire on that money, you need at least $1 million when you retire in order for that to pay you about $100,000 a year when you retire. So, and that's only going to last for about 10 years. So you have to think about all of these little things that we just usually don't think about. We don't think about, when you think about $1 million in your IRA or in your retirement account somewhere, you're just thinking like, oh, I don't know how I'm going to do that. But this money has to be invested in something. So you might be like Mitt Romney, and also a guy that you might know who is Elon Musk's partner. His name is Peter Thiel. Peter Thiel invested his self-directed IRA into the IPO for PayPal, into PayPal, I think before it went IPO. And he basically put his money there and made that account into a multi-billion-dollar account, tax-free, tax-deferred, actually tax-free, because if you look up this article about Peter Thiel, if you don't know about it, and Mitt Romney, they used their self-directed IRAs to invest in real estate, to invest in businesses, and they did a Roth IRA. So those Roth IRAs, the money is just growing and growing and growing. So maybe you can only put X amount of money into your IRA, 6,000 to 10,000, or I can't remember what the number is, but it's very small. But then you take that money and you invest it in the right things. Now that's where you're getting that exponential growth for your retirement. So you have to think about things like that. The numbers just came out on the S&P 500, and the S&P 500 averages, if that IRA or 401k is invested in the stock market, simply in the S&P 500, it has averaged 10% per year. What's interesting is, I just saw something that blew my mind. We all heard of the 1929 Great Depression and the stock market crash, right? Well, it turns out that the stock market crash did not recover until it was something like 1932. No, it took 25 years. That was the number. It took 25 years until 1950 something for the stock market to actually recover. And I'm going to get that statistic and have it correct on Thursday. However, that was insane. So some people didn't live to see the correction happen, so they could see the 10% average per year. So there are times that the stock market just falls out of the sky. And I believe last year was one of those years where the stock market fell. The pandemic happened, the stock market fell, it didn't fully recover, or it recovered and dropped again last year. So if you've got your money in the stock market, that is something you might want to consider to be, have a percentage in. And so, asset allocation, I love that video from Tony because he talked about asset allocation. So this is a general disclaimer. I'm going to use phrases. This is for investors. I'm going to use forward-looking statements. I'm going to use statements that are projections. There is no guarantee and no promises. The legal disclaimer is Clearview Eastern Fund is a 506C, which means that we are registered as an exempt private placement through the SEC. And that means that basically we are a private company. We are offering you the opportunity to invest with us based on how we believe, but there's plenty of risk, and that is up to you. And Tony talked about that risk. No risk, no reward. So we just talked about this. These are some of the things that we love about the multifamily space as a vehicle to pay you continuously, unlike what we did already. It's not as time consuming. So from the passive investor side, you have complete free time. You don't have to worry about management. There's multiple properties. Now, here's a mistake that most of us make in the real estate space. We bought a lot of our property in New York, New Jersey. We have some in Ohio, we have Michigan. But let me tell you what they did in New Jersey. I thought New York was bad. And I was not. And when I came back after the last crash in around 2015, we started to go nuts buying. And I thought over the river on the other side of New York City, Hudson River in New Jersey, it was going to be easier to evict. And unfortunately, I found out because of the pandemic, as of this last year, there's a new regulation called the Anti-Eviction Act. And so if you have a 3 or 4 family in New Jersey and you've got a bad tenant, you're basically screwed. So you can't throw these people out. So, and I'll tell you why. So we are not looking in any of those spaces. And that's what's nice about investing with Clearview, is because we have underwritten and looked at the data and saw where the states were more landlord friendly and why they're more landlord friendly. So, you don't have to invest in your backyard when you're investing in with Clearview. You also have diversification of capital, because you're not throwing everything into, that one fixer-upper that may or may not, finish up the way you want it to. You're not, you don't have any challenge with, you still have the depreciation, and you basically have tax credits that are with forced depreciation. I'm going to go through all of that shortly. So everything that we look at purchasing is going to have a 12 to 24% annual rate of return and initial rate of return. And so what that means is over time, we do 6 to 8% preferred returns. I'll explain what that means. 7 to 9% cash on cash return, and a 1.5 to 3 times multiple. So without getting into all of the specific math, to keep it simple, remember when Tony talked about the time? If, a lot of us want to go and invest in those deals. Oh, I'm going to get, 5 times my money, 10 times my money. I had a really good friend of mine tell me that. He goes, Tanae, why would I invest in Clearview when, I'm going to make 30 times my money? He was doing some kind of Forex moves. Like, you can, but didn't you just tell me that you put $300,000 check to the IRS? Hello, are you listening to yourself? I'm not telling you to put all your money in this asset class. It's called asset allocation. You need to know how to, you make your earned income, and then you might do something with Forex, and you might do something with crypto, but you have to figure out what money you're going to put in a secure asset. So when we do our calculations, that 1.5 to 3 times multiple always happens somewhere between the 5 and 7 year mark with us. So as net operating income from each one of the apartments paying rents, it usually, our charts show between 5 and 7 years, we've doubled the initial investment that it took for us to buy that asset. And that's pretty cool. And so when you go back and you look at all of this 6 to 8% preferred return, that means that we don't get paid as the general partners until our limited partners get paid. So our mission, we strive to be relentless in negotiating the best possible returns to offer our investors consistent cash flow that fund lifestyles for generations. For me, it is all about generational wealth. we are buying properties that are going to sit there and we're not going to sell it every 3 to 5 years. Some investors, some REITs that you look at, they basically buy just to increase the value by increasing the rents, and then they flip it and they sell it every 3 to 5 years. That is not one of the plans of Clearview Eastern Fund. We are building legacy cash flow for all of our investors. So passive cash flow, 1.5 to 3 times multiple. I just covered this. So we buy below the Sun Belt. We buy in North Carolina, South Carolina, Florida, and Texas. We chose those specific areas because those areas are where the money is right now. That's where the money left and moved to. They left New Jersey and New York and California and, all these different places, and they moved below the Sun Belt. And so, after the pandemic, in addition, these states are landlord-friendly states. So landlord-friendly simply means that if someone is not paying their rent, the government is not going to force us to take their government program and allow them to sit there forever. It says if the tenant is late, we can actually provide an eviction. What's nice about the multifamily space is we do not manage the properties. Our property managers manage the properties. Our team only looks for the right property to buy, determines the business plan for the property, and then moves forward with hiring property management, and we just do asset management. So, when you're looking at the market, the reason why we choose specific areas in those states is because the rents are also 17 to 30% higher than they were a year ago. So we're looking for job growth. We're looking for the suburban markets, tertiary markets. This slide says 1970s. We actually are not buying anything less than 1980s. And we're buying B-class properties. So remember that note about timing? Last year, when we first did this slide, we would look at 1970s and we would look at C-class properties. 2023, there's a huge thing happening in this business. A lot of people that bought to flip are in trouble. People that bought to flip are in trouble because they had short-term bridge loans, and we're like Pac-Man looking for those deals to gobble up. And so we know we can get much better assets. And this is a package that we just got an accepted offer on right now. 3 separate complexes. It is the Waterstone Place. You can look this up on apartments.com. Waterstone Place apartment homes. I believe that one is in, I'll go over it in the next slide. Waterstone, Treehouse, and Stone Creek. So Treehouse Apartments is 297 apartments. You see this community? It's gorgeous. It is a gorgeous property in Austin, Texas. Austin, Texas, you say? Yes, where Tesla just put a huge factory. Yes, where several of the corporations also moved to. Yes, this is a beautiful suburban neighborhood called Parker Lane neighborhood, and it is absolutely gorgeous. 1985 build. And annual net operating income is $2.4 million. So would you like a piece of $2.4 million? Net operating income means that after everything is paid, after all the expenses, all the property management, everything, our investors are getting their piece of $2.4 million, $2.8 million. Where am I? Okay, $2.4 million. That's the current income. And we know within the next 5 to 7 years, we're going to be increasing the income another 400,000 simply for some very minor tweaks, very, very minor tweaks. We actually don't have any CapEx to do on this property. We are just looking at the lower rents in this area, in these properties. So Waterstone Place is in Stafford, Texas. All of the apartments are 3-bedroom. This was just built in 2001. Gorgeous property. Also, another 2 million plus in current net operating income that we're buying. Stone Creek Apartments, 297 apartments, 1s, 2s, 3-bedroom apartments built in 1997, another gorgeous community. So, this is what we do. Our property management that we hire in the area, there's already excellent property management on there. We'll probably leave those same guys on there. Here's our mentors, okay? So when it comes to moving to the next real estate investment type, real estate asset class, for me, it was very important that I took the income from the last property that we sold in the Bronx and put it into the right mentors. This is Tyler Devereaux and Ryan Woolley. These guys have over 2,000 doors, and they've been doing this for over 9 years. They've bought and sold property. So every time we're buying, we're selling, we have a team that we work with in each and every one of those markets of sponsors that actually already have assets in that market. It may not be Ryan or Tyler, but we have a network of partners that we say, hey, we're buying over in Austin. Who do you have over there that's going to help with the asset management? And they get a percentage of the deal. We also are working with one of the wonderful, great mentors, Mr. Grant Cardone. Our last package that we had, we pitched it to Grant, and Grant, told us, hey, I love the deal today, but you got to let it cook for a little longer. He goes, you've got your finger on the pulse, but you need to let that guy cook a little longer. And what he meant was it just wasn't time to buy that property. It was a distressed owner, and it was a perfect situation like I just explained, but Grant said, wait on it. And that's why we have these types of mentors. Here's some of the people in our network. Vanessa Alfaro is one of the people we'll be calling on the Austin, Stafford, and the other deal. I just spoke to her last week, and she's closing several deals. Seth Sundberg is out of the New Orleans market whenever we've got stuff going on over in Raleigh or over in that area. And these two work together as well. We also have a network with Quattro Capital. So anytime this team, they've bought several properties and they're all over. They're in a lot of the same states. So depending on where we're buying, we find the deal, we put it together, we have our investors, and then we bring them in as partners so that our partners can work with us. So we've got a nice network of partners. So, we've all heard this. You don't wait to buy real estate. You buy real estate and wait. So you all may have 401ks that you have at your job or left one at your job. We work with a third party custodian that can help you, and you can get referred to Strata Trust Company, one of our partners. They will help you move your 401k into a self-directed IRA. And with that self-directed IRA, you could be like Peter Thiel or Mitt Romney and be a Billy Badass, okay? You might have a 1031 exchange where you just sold a property and now you've got money that you need to move over, or you've got that 401k. The Clearview Eastern Fund is raising a total of $25 million to buy not just that portfolio, but several portfolios. So we are going to have a diversified portfolio of property. So I just told you about a little over $6 or $7 million in income in that property. We only need about $5.8 million from our fund to get that deal done, even though it's over $100 million. And that's because of my 20 odd years in being very savvy at putting deals together. So if you want more information on that, I can dive deeper, but you can learn everything about that deal and more about Clearview Eastern Fund by going to clearvieweastern.com. And at Clearview Eastern, you can see all the details, all the finer details I didn't cover in the presentation about that those properties. And those are all in our investor portal. You do have to register, and you'll see all of that information. Our offerings are only available to accredited investors. So in order to be considered an accredited investor, you have to make at least $250,000 a year if you're an individual. You have, or if you're a couple, $300,000 if you're a couple. If you're a business, you can also get accredited. And if you're a trust, you could be accredited. So there's a lot of ways that you could be accredited. I don't know where your funds are. We have third-party verification systems already set up in the platform. So when you go to say, okay, I want to invest, the system will go through the third party. You can provide your accreditation letter, or it'll go through the third-party verification, and they will get you accredited. It's really simple. And the next step, like I said, you submit your accreditation letter, choose what type of entity. We work with a lot of family offices. The minimum investment with anything, if you want to get involved, is at least $100,000. We are working with people to put a soft deposit down. So a soft deposit means that you can start with 10% down. So that's $10,000 to secure your spot. That 10% means to us that you actually have $100,000. We don't do a capital call until we're about to close on a property, but you could at least lock yourself in and make sure that you are ready, so that when we do go to close on that property or any other, you are already locked in. So I'm going to open it up for questions. Any questions? I am here. Please raise your hand or put it in the chat.
Well, today I'm at work. I was just listening in. I want to say great presentation again.
Thank you.
I really enjoyed it. I was a little late, so I apologize, but I made it. I really enjoyed it.
Thank you so much. Thank you for showing up, Jalen. You are amazing. And you and your team are amazing. I'm so excited. And I'm glad you even spoke up, because for those of you that are not accredited and you go, daggone, if only I had money right now so I can get in on this. I'll tell you, it's one of those situations where you definitely are going to wish you had some kind of way to get in, and I figured out how to get you in. Okay. Even if you don't have any money, even if you don't have any credit, even if you're not accredited, you can get in by wholesaling a deal to us. And we have an entire class on how to wholesale real estate and how to wholesale large multifamily apartment buildings to us. I know this sounds insane, and guess what? You're not really wholesaling. We're actually going to include you, not just give you a commission for going to find the building, but we're actually going to give you a piece at closing. So just like if you broker something, you get a commission at closing. It's called an acquisition fee. So you'll get a piece of the acquisition fee, and you're also going to get included in the equity. So you'll be able to get some of that cash flow. We have that available on our e-learning platform at levelupadvisors.com. So you can go to levelupadvisors.com, click on, you have to go on your, if you go on your phone, turn your phone sideways so you can see the menu, because you have to go to the toolbox. It'll say tools or toolbox. Right there, once you get to that page, if you go on a PC, then it's easy. You just click on tools or toolbox. And right at the top of the page, you'll see the availability of the wholesale real estate course, how to wholesale multifamily apartment buildings. We have a goal to gather 1,500 doors. So let's do it together. We're going to show you how to find these distressed owners, like the one I pitched to Grant. We're going to show you how to find these owners that have bridge loans that are expiring or with really high interest now because they had no cap. Those are the deals that we're looking for right now because we have a strategic partnership with a lender that will actually work with those sponsors to help bail them out. And guess what? This is really important for you to know. As a limited partner, those people that are in trouble on those apartment buildings, they will be bailed out. You don't, so the likelihood, and I don't want to get into any guarantees. However, the risk is lower when you have a secured asset like an apartment building. So this is Tanae Williams. I don't see any questions. If you have any other questions, just hit us up. Whoever invited you, get back to whoever invited you, or DM me on Instagram. And thank you so much for tonight for joining me.